All right, guys, what is going on? Welcome back. Bitcoin and Buildings. I'm here with somebody who has kind of popped on my radar recently. I think he's been around a while. I don't really know. We're just getting to know each other now. But you see him everywhere on if you're in the Bitcoin space and you're on X and you're on YouTube and stuff like that, you've probably seen Joe Consorti's work around. Another guy who is just pumping out quality, content's one thing, but punctual ideas that make a lot of sense and have high impact. That's stuff I start to notice. So I reached out and he was, gracious enough to come spend some time with us and talk about, yes, Bitcoin and markets and stuff, but also his take on real estate and kind of the, blend of the two, how they work back and forth with each other. So welcome. How are you doing? I know you just got back from a long honeymoon. So riding high, I assume.
That's right. Yeah, nice and relaxed, doing great. It was my first vacation in years, so happy to have taken it. But yeah, now back in the grind, and pleasure to be speaking with you today.
Nice, thanks, man. Well, all right. So, all right, give it to me straight. What's your where are we at right now in the snapshot of Bitcoin in 2025? What's your take on Bitcoin? Your take on markets? Just the world in general.
Yeah, no, absolutely. So with Bitcoin, I mean, it's at an interesting point, right? So it's been consolidating around this $110,000 level, above 110, for the better part of a month and a half, 2 months. I mean, actually four, looking all the way back to March. And so not all the way back to March, 6 months, looking all the way back to March. And so really it's that's a sign of strength. Like, a lot of people will get bored when this kind of stuff happens, but Bitcoin's been here before. And ultimately, the more time it spends at these price levels, the stronger of a base it has for the next leg higher. So Bitcoin is kind of an asset after the the ETFs. It's moved into this new era as an asset where it kind of stair steps for a while. So it'll consolidate and then kind of explode higher to the next stair, and then consolidate and then explode higher. And that's just kind of what Bitcoin has been doing in this new era. Bitcoin is an asset that historically has tended to have these, long periods where basically nothing happens, and then it explodes higher over the period of 6 to 9 months, and then there's a blow off top, and it has a 80% downturn. At least that's been the case for the last 3-4 cycles. This cycle is a little bit different because of the players involved. The folks that are holding it are much less paper-handed per se. You look at institutions who are buying these ETFs, right? Like pensions and endowments and others who plan on holding these things for years, if not decades, without ever selling. And they know the asset they're holding, and they'll weather the volatility, and they'll scoop up coins from folks who are selling at these levels. So we're in this period where Bitcoin has entered another multi-month consolidation period, and it's just priming itself for its next leg higher, which will be catalyzed by the Federal Reserve cutting rates next week, actually 7 days from today, on Wednesday, September 17th. And, historically, when that has happened, Bitcoin likes that quite a bit. I posted a chart earlier this morning. It rallied, I think, 695% in 20 months after the Fed's first rate cut in 2020/2019, and then 115% in the last 11 months, since actually last September, the Fed started its rate cutting cycle before it ended it. So yeah, no, kind of TLDR, Bitcoin's primed for the next run into the end of the year, into a strong Q4.
And all in all, the cycle continues. It's funny that the whole idea that you just described is like they either scare you out or they wear you out in markets, right? And it seems as if a lot of people have been worn out in this case. You look back 2025 performance and they're just like, where are we? We're not, but then if you go back a whole year, all of a sudden it gets back to that start of the rate cut cycle, and it's like, no, like, things are actually progressing. And it is weird to actually think we kind of are in a rate cut cycle already. Like, it feels like we haven't started because it's been so long since it was September 2024. I think that's when it first started. So exactly. It feels like we're starting again into a rate cutting cycle. And I have to agree with you. To me, you can quibble about all the different things, but in the end, the setup kind of just looks great to me moving forward. And the more noise and narratives that come along, to me, it's just a bigger wall of worry to climb. And honestly, like you said, if we've set a base for so long and we have a lot of people unallocated and sidelined, that's actually a pretty good argument for price appreciation moving much faster, much higher, I think, moving forward. So we'll see. We'll see. Who knows? But of course, we have to back up and say, Bitcoin can do whatever. It's a long-term outlook. We're probably both in it for, I would assume, decades, and a lot can happen over that time. So outside of Bitcoin specifically, do you foresee general markets and maybe touch base on real estate as well being in a good spot, or do you see a divergence?
Yeah, I'd wager so. I mean, generally, Bitcoin is really correlated tightly to these the rest of the risk bucket per se. So the S&P 500, the Nasdaq, basically every other risk asset there is. One of the biggest informational asymmetries in markets today, and I've said it for a very long time, is that Bitcoin trades like a risk asset, but its monetary properties allow it to be the apex risk-off asset. This pristine asset that you want to own in good times, but especially in bad times, at least as far as markets are concerned. We're not there yet. So Bitcoin will continue to trade right alongside the risk bucket when conditions for risk are doing well, i.e. you start to see minor cooling off in the economy and the Fed is cutting into a cooling economy, at least at the margin. Risk assets love that. If the Fed was cutting into extreme weakness, like if the Fed was really late to the curve, the risk bucket would not love that, right? And so we're in a situation where we're kind of blessed with this situation where, the economy is cooling off at the margin. The Fed is now stepping in with this rate cut. Ideally, we don't get, too much bad news as far as the economy is concerned over the next several months as the Fed embarks on this cutting cycle. The risk bucket does well. And also, speaking of real estate, I mean, we talk about how that market will perform heading into Q4 following this, the commencement of this rate cutting cycle where, the Fed's policy rates are supposed to come down by 125 basis points. Ultimately, Scott Bessent and President Trump said that they would be declaring a national housing emergency in the fall, whatever that means. I tend to think it'll mean trying to get new buyers into the market, right? But they have to do that in such a way that protects real estate prices and continues to allow them to ratchet higher. Because real estate's a politically protected asset class. We can get into this, but really post 2008, they've demonstrated that real estate is a politically protected asset class. And then also in 2020, they demonstrated that the rest of, the S&P 500 American markets are politically protected. So they'll do whatever they can to set a floor underneath those things and also make sure that they rise at their normal clip year after year. So I don't know what they'll do in the fall in order to get new buyers into the market, but it's looking up, frankly, for all of those asset classes.
Yeah, it's a really interesting, because when I think about interest rates and stuff, right? If we're going to be kind of pushing forward here, maybe, well, it's a whole topic in its own right, where if you cut rates into an economy that's doing okay, if we still have inflationary pressures, the long end could show you that. And you wonder, well, that clearly impacts real estate mortgages and things like that. So what do in a weird way, is it like a verbal attempt at yield curve control that's coming in a way, and then the escape hatch for volatility or whatever will be the currency? And if that's the case, probably pretty good for risk assets, like you said, if things aren't falling apart.
Yeah, for sure. I mean, the yields coming in, particularly on the long end, that highlights, falling growth and inflation expectations. And so ultimately, like, the Fed doesn't control that. That's entirely the market telling you that it thinks growth and inflation expectations are coming in. So the Fed cutting into that is a good thing. On aggregate, since December, I think the 10-year has come down by like 80 basis points. It's now basically right at 4%, excuse me. So that kind of highlights investor demand for treasuries, right? Investors are moving down the curve. They can see that the economy is cooling. They can see that the Fed is cutting rates, and they want to get in at these, good yields as the Fed embarks on that. That obviously brings down mortgage rates. And at the margin, on a long enough horizon, that does draw people into risk assets. It moves people out on the curve. Because the yields in the U.S. Treasury market are less desirable. So really, this is just a a classic case of the Fed engaging in rate cuts, and I'm frankly excited to kind of live through Q4 and see what happens.
Mm. All right, so you just mentioned this like a couple minutes ago, but I'll have you dive into it a little bit more. The politically protected asset class that is the hidden third mandate, which was one of the titles of a video of yours. So why is that? Is it a demographic thing? Why do we have this hidden third mandate?
It's all about retirement portfolios, right? So if you take a look at the American wealth, it's about 50 to 60% concentrated in homes on average, and the rest of it is in equities, right? Primarily equities and bonds. Generally, people are more lopsided towards equities these days. And really, since you've started to see this since 2008, basically it's called, people have dubbed it the Fed put. It's the third shadow mandate of the Fed. It's become a politically protected asset class in order to protect Americans' retirement accounts. It's the last thing they want to do is induce the negative wealth effect, right? Whereby people feel, less wealthy as a result of their wealth going down on paper when stocks sell off and things like that. And so they go and they don't spend as much money.
Yeah.
And so ultimately, that's kind of why real estate alongside stocks have both become politically protected asset classes, because the economy hinges on people spending money. You take a look at GDP, this idea that kind of consumption drives everything else. So consumption is the hallmark of American prosperity, not actual American prosperity metrics, home ownership or child rearing or anything like that, but other metrics such as consumption, right? Whether you're an individual, a business, etc. And so that's basically why they're politically protected asset classes, because if they weren't and the Fed allowed the S&P 500 to go into a 20%, 30% correction that lasted years on end, people would spend less money into the economy. As a result, GDP would go down. Our debt would become less desirable at the margin. And that's the last thing that the United States wants. So that's the Fed's third shadow mandate, alongside full employment and stable price inflation at 2%. And really, unfortunately, it's a dangerous game. It means that, individuals who do not yet own assets are increasingly priced out of owning assets because wages simply cannot keep up with a central bank whose third mandate that it doesn't tell anyone about is to make sure that it inflates asset prices ad infinitum. I put out a tweet about this. All the Fed has successfully managed to do in its century plus of existence is inflate asset prices. It couldn't successfully manage our currency. We left the gold standard. It could not successfully maintain full employment because it's using information that's increasingly inaccurate. All that it has managed to successfully do over a multi-decade time period without fail is inflate asset prices. So it's really an institution that doesn't work for the people, that has failed in every single way. But the good news is that there's Bitcoin, which is this asset that exists outside of that world. It's traded within that world, but it is very much outside of that world in the sense that, it directly benefits when the Fed does what it does, when it manages interest rates and keeps them below the real level of inflation and inflates asset prices away. It's uniquely positioned to benefit against that backdrop more than any other asset. So, thank God for Bitcoin amidst this environment. But that's essentially why, real estate, equities, those are politically protected asset classes, despite what the Fed may tell you.
So if it's kind of the third mandate to keep, asset prices rising at least, a reasonable thing for everybody who owns these assets and these retirement people who are, a lot of their wealth is stuck within these homes. If it's still going to stay unaffordable moving forward, like, how does this work? They don't want to sell a house. Like, they got a few options, I guess. They could downsize. They're not willing to sell their price or their homes for lower. Maybe they pass away and their children get it. Does what happens to the housing market? This is what's confusing me, is like, well, if we start rate cutting and get things moving again, housing prices could just keep going higher, and like the unaffordability problem just keeps getting worse. So is it to your point just like exacerbating the problems that have always existed? And where does that leave the younger generation and the ability to participate here?
That's correct. Ultimately, as a result of the Fed's actions and inflating asset prices, it's really priced out younger generations increasingly from owning homes. You look at the um, age of home buyers. The average age of a home buyer in the United States is well into their 50s and 60s. There are actually more homeowners, people buying homes over the age of 75 than there were people buying homes last year over the under the age of 35.
Yeah.
So ultimately, if any other metric would scream at you and tell you that young people are being priced out of the market, that's one of them. You also take a look at other behaviors such as child rearing. I mentioned earlier. The median age of marriage has moved from, I think in 1950 it was 21 for women, 23 for guys, and now it is 29 for women and 32 for guys. And so ultimately it keeps moving up. People are doing these just normal human functions that they should be doing at a later date in life. They're putting those things off because of how unaffordable everything is. Obviously, we have a culture problem on the other end of that. But the money problem is more than most, kind of chiefly at the center of all of this. And so, that's ultimately what the Fed has done by managing interest rates to a level, or by influencing interest rates to a level that are low enough to keep it manageable for the U.S. Treasury in order to not go bankrupt or not have to print the difference using the Fed. They have kind of they've pushed out an entire generation of home buyers, an entire generation of asset buyers. And that's why you're starting to see so much financial nihilism, so many people going and buying different versions of a lottery ticket, right? Sports gambling websites, crypto, right? Non-Bitcoin crypto, quote unquote. These are different variations of a lottery ticket. People feel that the only way that they can get ahead is through these means and these means alone. Thankfully, Bitcoin solves for all of that. But you're exactly right. It's pushed out an entire generation of young people from owning these assets. I think the way that you fix this, there are several different ways in which you can fix this. I think chief among them, the Trump administration is already doing. I think another thing they can do is build more homes, cut the red tape, build more homes, and also make it so that firms cannot purchase residential real estate as an investment. Like you can't buy and hold and sit on real estate. But that's less of a problem than A, the money problem, and B, the fact that we just simply aren't building enough homes. And also building smaller, more manageable homes. I think that one of the big reasons, I don't think that, I know that one of the big reasons houses are unaffordable, it's a smaller reason relative to the others, but that the square footage on homes has increased 25 to 40% since 1950. And it's frankly mostly unnecessary square footage, right? Living rooms larger than they need to be, kitchens larger than they need to be. Obviously, times have changed, and so that's what's preferable. But that's another component of this issue. Ultimately, really, it just boils down to a money problem. And so young individuals need to do two things. They need to acquire marketable skills, get a position, that they can use those marketable skills within, provide as much value as they can, and store their earnings into money that can't be debased. And that's Bitcoin. I wholeheartedly believe that. And that's what I preach, whenever I'm doing one of these shows. That's how young people can get out of this, because, the Federal Reserve has clearly demonstrated, our leaders have clearly demonstrated for the last few decades that they really are not concerned with any of that.
But Joe, how do you keep the kids away from the other cryptos? You tell them to go get a job, be marketable, build a skill set, but then don't play with the hot fire over here. Go to Bitcoin. That's already over $100,000 a coin. How could they ever possibly partake in that system? How do you
Right.
convince them to stop
Yeah.
with the others?
Yeah, there's a lot of unit bias out there. I think the
Mhm.
primary way that you do it is just through education, right? Letting people know that they can buy fractions of a Bitcoin instead of one. Again, unit bias is something that plagues us all. You see Bitcoin, it's $113,000. You go, that is way too expensive. Most people have absolutely no idea that you can buy a fraction of one. They don't even know what the individual unit of a Bitcoin is called. And so much more education needs to be done in order to tell people that. But also, young people learn through experience, right? Like young people will put up a great deal of money. I know many people who have into something that is not Bitcoin, some other crypto token, who's trying to essentially be an affinity scam. That's what all of these things are. And convince other people to buy that instead of Bitcoin, and they lose all their money. Whether it was the ICO bubble in 2017, whether it's what happened in 2022. There's no free lunch whatsoever. There is Bitcoin, right? But there are all of these other assets that are priced at an extremely low market cap, essentially, less expensive or just as expensive as a penny stock of these get rich quick schemes, essentially, in order to enrich insiders. They all go to zero on a long enough time horizon, not just against the US dollar, but against Bitcoin. And so trials and tribulations and people experiencing these things coupled with education, right? I have hammered since I started writing about Bitcoin and started working in the industry that there's Bitcoin and there's everything else. I make it my own notation, my own writing style to put crypto in quotation marks whenever I'm writing about it, because I don't take it seriously as a legitimate asset class. That's what I'm doing in order to try to educate folks. But I think seeing the results of these things over time relative to Bitcoin, everything claiming to be a better Bitcoin or the next Bitcoin has gone to zero in both dollar terms and against BTC. So it's a function of those two things in tandem: just time, people losing all of their money, and education. And I think eventually we'll get there.
Yeah, losing your money does teach you wonders moving through time. Yeah, one thing I've noticed that's been starting to really hit home with people I talk to in Normie Land is re-anchoring their mind on 1 million instead of 100,000. So whenever I start to talk and reference like the bigger picture of Bitcoin and where I think it could end up and how it could kind of be present in the world, once I start throwing that number enough at them, it seems to dissolve the $100,000 thing a little bit, and then it like dulls that blindedness in their kind of way to think about the price. And it's actually been pretty interesting, which is why I'm so happy that we're spending time above 100,000, because once it can like let that magnet go and start to focus on other things, 200, 300, 600, 400, 300, whatever, the anchor point changes and people can stop doing that. And while you were talking, I looked up I had a memory of like the Berkshire Hathaway Class A stock as being like very expensive. So do you have any idea of like the price of the Class A Berkshire Hathaway stock, like what it is?
Absolutely no idea.
Okay, 740,000.
Yeah. So I had an idea. It was extremely expensive. Yeah.
Yeah. So like, there are things in the world that exist, and with somebody that you say that to, when you say Berkshire Hathaway and Warren Buffett, will they be like, I would never touch that thing because it's so expensive? Like, no, they might actually look at that as like a safe, long-term store of value because of that brand and its ability to grow throughout time. So it'll happen over time. It'll be interesting how we progress, moving forward.
Yeah.
So
yeah, absolutely.
All right. So when it comes to, you mentioned on one of your videos the idea of people using their house as a bank account. How do you see that? Is that good? Is that bad? Why do they do it? And just dive in a little bit there.
Yeah, absolutely. Ultimately, homes are appreciating right now. The national average, the Case-Shiller national average, obviously this varies from market to market, but the Case-Shiller national average right now is 2%. It tracks national home prices. If you go to, the 20 largest cities, it's a little bit over 2%, 2.5 maybe. But historically, this is pretty low. Generally it's around 3, if not a little bit more. It varies from market to market, but under 2%, you're not keeping up with inflation with all your money in your house. And at this current state, if you went out and bought a house today at these extremely inflated levels, right, relatively speaking, at the current mortgage rates, right, 30 years, 6.5 to 7%, you are kind of, you're really putting your money in something that isn't going to outpace inflation or the cost of living. And so really, now that there exist tools to kind of move out of that and diversify out of that, there is a way that people can kind of insulate themselves from everything that's happening. One other thing that I'll say is that I saw a video today and I largely agree with it. It's that, if you have a mortgage, keep your mortgage, right? Particularly because I believe it was 60 to 80% of new mortgages in 2021 and 2022 were refinances. And so you look at the average outstanding rate of mortgages, they're very low. They're 2 to 3.5, maybe even 4% on the very high end. That's the lowest it's going to be for probably a very long time. Meanwhile, you have assets like Bitcoin or even the S&P 500 that are doing, in the S&P 500's case, 13% a year. That's a 10-year compound annual growth rate. Bitcoin, 30 to 40 to 50% a year. I think its 10-year compound annual growth rate is like 80 something, which is nuts. Over its lowest multi-year compound annual growth rate, so its annual growth rate year after year, was 26%. And that's over a 4-year period. So from September of 2021, and that's when Bitcoin had fallen to nearly the trough of its bear market, until today. Its lowest multi-year compound annual growth rate is its 4-year one, and it's 26%. And so ultimately, having all of your money in your house is a really bad play. You could do one of two things. You could either rent or live below your means and take that difference and invest it in Bitcoin. Or if you are already in a home and you are locked into your mortgage, do not sell. With Horizon, obviously, and I think we'll touch on this later, is, we've kind of created this really wonderful tool where if you are in your home, you can swap out a portion of your home's value for tax-free cash to buy Bitcoin, or anything else for that matter, any asset that you believe in, that you believe will do better than your home. Because we're at a point in this country where actually this particular thing I'm about to say has never happened before. The price of new homes is lower than the price of existing homes. And that is an entirely, fed, stamped, signed, sealed, delivered creation. The reason that is the case is because in 2020 and 2021, home prices boomed. They skyrocketed. Mortgage rates were slammed, as low as can be. I think my mother locked in a 2.15% mortgage rate. So like the absolute bottom, best trader ever, right? So she's not moving anytime soon. Now the home is worth an insane amount of money compared to what she bought it for. So those people aren't moving. They're not swapping out their home, even if you need to downsize. They're not swapping out their house for another one that has a completely exorbitant mortgage rate relative to what they have. And also buyers cannot enter the market now. Buyers can't come in and buy these homes with insanely high mortgage rates. Home affordability is actually at an all-time low as well. And so what happens is you have buyers that don't want to move because they're sitting on this mountain of capital. Other people who want to buy it can't afford it, not only because it's so inflated, but also because the carry on it is too much. The mortgage rates are too high. So homes aren't selling as fast as they were, but new construction has to be sold. These home builders are sitting on this construction debt that they use to fund these projects, and they got to get them off their books and rotate into the next one. And so they're ratcheting down their prices just to get these things off of their books. And what you see for the first time ever is that new builds are less expensive than old builds. Should not happen, should never happen. People will say that it's a material issue, it's this, it's that. All those things exist, namely the build quality, materials, etc. But the primary issue here is that there's one central entity that controls the price of money, and it massively screwed up in 2020, and it's put us in this situation we are today.
Yeah. A small group of people putting us into a big situations. So, and guys, if you want all of these topics, Joe's hitting really well on. He has, let's say your average video average is what, 3-4 minutes roughly on YouTube?
Yeah, two to 4 minminutes is what I kept out.
Yeah, it's nice. Nice little bite-sized things, guys. So if any of these topics jump out, he has them all well organized on his YouTube channel, just Joe Consorti. I'll link it below as well, but go check them out. To add on, I'm trying to kind of converge a lot of them into this conversation, but when it comes to the idea of this, a lot of money being stored there, I want you to touch base a little bit on probably my favorite video you made was the trapped premium in the real estate in America, I guess globally as well. But there's like $130 trillion of real estate premium kind of trapped into that ecosystem because of what you've mentioned before, kind of post 1971. So do you want to just dive into that a little bit? I think it's really enlightening.
Absolutely. Yeah. So I put out a report called The Great Repricing back in July. And really it outlines this monetary premium that's existing in global real estate. What I mean by monetary premium is a speculative excess that exists beyond the home's utility value and location. You can define it really any way you want, but essentially that's kind of how I define it. Beyond what a home is used for and where it's located, how much additional capital is trapped in there. And I estimated using very rough numbers, basically taking all of the averages that I could and then extrapolating US data out globally, which doesn't work at all. That's a
Yeah.
statistical fallacy. But to give us a rough estimate, 120, $130 trillion worth of capital in global real estate, which is a $370 trillion market, shouldn't be there. It's solely there to create this premium. And it's a result of homes being treated as an investment. Post 1971, all of this monetary capital that used to be in hard assets and even that held the dollar in US treasuries when it was backed by gold had to find a brand new home. It had to find a home that was relatively scarce, relatively liquid, but that could be held and could appreciate reliably over time. And real estate became one of those asset classes. Real estate and gold became those two chief asset classes alongside the S&P 500. What that has done over the last 54 years is as homes have become an investment more so than they become a place to live, it's been treated that way, right? So you have people buying them in aggregate. You have people buying them solely for the purposes of renting them out to others. And this has really distorted our view on what homes should be and how they should behave. One of the top 10 jobs that Gen Z wanted to be, my generation, was a landlord. They wanted to be landlords because this notion of owning a property and free money coming in and you've got a mortgage on it that's lower than your rent, it's extremely enticing, right? I know a great deal of people in my personal circle who either at one point wanted to be or currently are people who go and they finance Airbnbs and they fix them up and they go and rent them out to people, these short-term rental properties. And it's quite unfortunate the way that this is all unfolded. And so, if you take a look at residential real estate, it is the biggest offender because it is the largest area of the market, if you will, in real estate. And basically this premium, that's 30 to 40% conservatively. This is a very conservative estimate, above what the home should be. If that monetary premium were eradicated completely, home affordability would jump through the roof. You'd see young people like myself going out and buying homes in droves, but that's simply not the case. That's not what we're experiencing. And so long as there wasn't a better alternative, real estate served as this monetary asset. Now there is a better alternative. We're on a show called Bitcoin and Buildings. Ultimately, Bitcoin serves as a superior store of value asset to real estate. Real estate serves its purpose. It's tried and true. It's not going away. It will definitely continue to be an investment asset, but there exists a superior one, not just for real estate investors to rotate out of real estate and into Bitcoin, but that's not what I suggest. Actually, I suggest, folks who own real estate incorporate Bitcoin into their holdings somehow, some way. You can shed off some of the properties that don't have a great yield, that require a lot of maintenance, that may be in a bad area, what have you. And you can simply buy Bitcoin instead. And for your great properties, the ones you don't want to let go of, you can take out financing in order to buy Bitcoin and basically add it to the balance sheet, proverbially, of that property. You can go ahead and take the cash flows from that property and invest it into Bitcoin, or a portion of those into Bitcoin. There are a number of things you could do as a real estate investor, as a real estate owner, in order to incorporate Bitcoin into your portfolio, because ultimately Bitcoin is siphoning away some of this monetary premium. The reason I know this is that over the last 6 years, Bitcoin has increased 14 times relative to real estate. That means capital came from all over the world and invested itself into Bitcoin. Granted, that's not a direct outflow from real estate into Bitcoin. There is no way to measure that. But at the very least, we know that Bitcoin is monetizing at an accelerating clip relative to where global real estate is. It's safe to assume that some of that capital went directly from real estate into Bitcoin. And so real estate is, in a very real way, siphoning the monetary premium from monetary and non-monetary assets all over the world. And one of those is real estate. It is the largest single asset class in the world, asset market in the world. And ultimately, this is the direction we're headed. Thank God there now exists a superior store of value to real estate, so that at the very least, at the margin, some of that monetary premium can make its way over to Bitcoin.
Yeah, I mean, anecdotally, even the money that's not already in that system that's getting eaten away at the margin, like I have money come in and I have my options and I just decide, maybe I would have put it into this multifamily property for cash flow, but I'm just going to go ahead and buy Bitcoin here. That's effectively taking away from a growing, real estate equity pile. So the money coming in and taking money from the value that's already within there is I think it's pretty obvious, and it's going to get more and more obvious. But I think you make a good point. Like, you don't we don't have to live in this binary world. There are ways to make this a happy marriage together, especially even psychologically speaking, right? I love investor psychology, trading psychology. That like it's like one of my things I really love to talk about. And for me, I understand that like, well, why aren't you just all in Bitcoin then if you like really like it and like it's going to outperform? Like, yeah, I get it, but there's also like when you do experience high volatility and you're exposed to that, you then subsequently can make worse decisions at bad times because you're trying to maximize it. So I'm willing to sacrifice certain amount of gains and yield to be able to live a life that is a bit more, I don't even know the right word, low key, if we will. So
Yeah.
I like that. And there's different things for everybody, right? Different risk tolerances, time horizons. I get it. So
Exactly. Yeah.
yeah. So this is all just a narrative that's like become a reflexive narrative since we came off the gold standard, right? And the money started going there, which makes more people think it's this, and then it's become so deep rooted into the American culture, especially in America, of like owning a home is like it's the best utility, it's the best investment, it's the tax situation, the blah blah, insert whatever. So do you think the threads are unwinding here to a point where it'll finally free up a lot of that capital, or do you see it being a little bit tougher than it being that easy?
Yeah. I believe that you mentioned people have different risk tolerances. I'm not of the opinion that, everybody will dump their real estate holdings and go and buy Bitcoin. I'm not of the opinion that people will sell their house and then go and buy Bitcoin. An asset's value goes far beyond what its growth rate is, what its appreciation is. A home is no better example of that, right? A house is a place to live, to raise your family, to watch your children grow. That's what a house is, and so people will continue buying them because that the value that holds goes beyond any monetary asset that there is. That said, at the margin, folks who are using homes as investments are simply doing themselves a huge disservice if they're forfeiting other options out there in the market, such as Bitcoin. Bitcoin serves real estate's monetary function better than real estate does, right? It's this absolutely scarce vehicle, whereas real estate held its value because of its cash flows, but also a huge component of it was because of its scarcity. But real estate scarcity, like gold, is only relatively scarce, and so Bitcoin trumps both gold and real estate on that front, in that it's absolutely scarce, immutably, right? Those rules can't be changed. In addition, it's highly liquid, right? So it trumps real estate on that front. If you want to get out of a property fast and you need that liquid capital for whatever reason, then you can't really do that, right, with real estate. Whereas with Bitcoin, you certainly can. And so there are a number of areas, namely in its scarcity, which is why real estate as a store of value, not as a cash flowing asset, is inferior to Bitcoin. As a cash flowing mechanism, real estate is superior to Bitcoin, but I don't believe that'll last forever. I do believe that these new types of fixed income instruments that are coming onto the market, that are adjacent to Bitcoin and backed by Bitcoin, will prove to be a superior alternative for some real estate investors, relative to the real estate investment trusts or other fixed income real estate vehicles that they're holding. I think, one of the big areas that can really combine these two worlds, we talk about different risk tolerances, is a fixed income instrument, whether a convertible stock or a preferred stock or what have you, convertible note, is an instrument that has both real estate and Bitcoin in it. Real estate for that sort of downside protection, to kind of mute Bitcoin's downside volatility, but also enough Bitcoin to really make it so that the beta on it is great. So instead of, a kind of a Bitcoin backed real estate fixed income instrument, where instead of earning a 6 to 7% yield on your United States REIT, a 6 to 7% annualized dividend, you are instead earning 11 to 12 to 13%. That's more than a 50% haircut on Bitcoin's annual growth rate. However, it's conservative enough to where real estate investors may be enticed by it. And other characteristics of this product, such as the downside protection, would make that really enticing to real estate investors. I think that that's one of the ways in which this narrative that you mentioned has become reflexive actually becomes more than just narrative. It becomes reality, where this new kind of financial instrumentation allows for real estate investors to not wholly dump their portfolios, but perhaps instead of investing, that entire portion of their portfolio that was cordoned off to REITs in REITs, they go and maybe do 50-50 between REITs and this new Bitcoin real estate hybrid vehicle. I think that is one of the major ways in which you can attract capital away from real estate and into Bitcoin, siphon away that monetary premium and make this more than just a narrative. Another way that's happening, which we're actually building at Horizon, we're allowing homeowners to kind of swap out of one and into the other at the individual level. And so if you believe that Bitcoin is going to do better than your home over a multi-year period, you can use Horizon to swap out a prudent portion of it to invest in Bitcoin. There are a number of other solutions out there for this as well. And so, I think that as businesses like ours continue to proliferate and be successful, I do believe that a lot of real estate folks may be turning their heads and saying, hey, what's that over there? And start building for that instead. Start building these fixed income instruments, start making these different bridges per se for capital to go from one area of the market into the other, really for the betterment of humanity, frankly, given the way that home ownership is headed in the United States today.
Yeah, I think that's great. I think it's the Cardone brothers, hate them or love them, which I always say because I know a lot of people have their feelings, but they are bridging that gap. I think it's Gary maybe has had enough dinners now with Grant to convince him that this is an important part of the future, and they are starting these hybrid developments, with these huge Class A buildings that provide a yield, but they will also tack on 20% of the total price into Bitcoin and have it be like a lower guaranteed yield, but a higher potential outcome if Bitcoin were to perform well alongside of it. And I think that's a really cool way to dull the blow of Bitcoin for people, to be like, nah, like relax. We still got the building. We're still cash flowing. We're still in the same funnel you were in. But if Bitcoin does well, instead of getting, ARR of 8% overall on this deal, you're going to have 15, 20, 25%. Who knows? But in the end, if it goes to zero, if it's a scam like you think it is, it's okay. Yeah. You're still doing your same thing. And I love that thing. Because before I forget, one thing you mentioned is like, a lot of people are focused on, hey, I want to be a renter. I want to be a landlord. I want to do this thing. I want to own an Airbnb, whatever. I think there's this chasm that people have a hard time crossing of seeing Bitcoin as like this ethereal thing where like, wait, you're telling me that I can buy something, it'll go up like on average 3 or 4 times as much as this, but I don't have to do any work. Like as a landlord, as a Airbnb, they can envision themselves buying this property, fixing it up, filling up the calendar, making sure everything's right, getting people turning through there. And then it's like they've earned that yield in a way, right? So they can like see it. But then you're saying, oh no, you can go buy this funny money over here, and you're telling me it's just free money. I don't buy it. Like I'm not gonna, So what do you think about that, like crossing that chasm there?
Right. I mean, I think it all comes down to being intellectually honest. I think that the allocators who spot this first and start doing this thing first are intellectually honest. There will always be detractors who are just detractors for the sake of it. Namely, there are a lot of gold bugs out there who just look at Bitcoin and its 16-year price history where it's managed to go from zero to the 6th largest asset in the world in a clear structural adoption pattern. And they still dismiss it, right? So there will always be those people, undoubtedly. But the first movers among them that kind of move from real estate into Bitcoin, or they incorporate this sort of hybrid approach, a couple of different methods I outlined earlier, those are going to be the ones that really kind of pave the way for this thing. We're trying to pave the way for it over at Horizon, and we've seen tremendous success with it. That really these two worlds, if you think about politically protected asset classes, Bitcoin is currently not one of them. Real estate is. And so ultimately, real estate is going to continue appreciating forever. In my mental model, these are not the views of Horizon. And Bitcoin is going to continue to do the exact same thing because of dollar debasement and because of its monetary properties that allow it to insulate the individual and the corporation from monetary debasement better than any other asset. And so I think it is the intellectually honest that move forward with these things first, that show the permanent skeptics and detractors, at least the ones who have a modicum of honesty, they begin moving in that direction as well. Ultimately, all it takes is a couple of visionaries in order to pave the way on this thing. You mentioned the Cardone brothers, Grant Cardone's new hybrid Bitcoin and real estate fund. That's another great example. Grant Cardone is a big name in the real estate space. He's created this fund. I'd wager that over the next couple of years, it's going to be an extremely high performing fund, and it's going to catch the eyes of a lot of allocators. At some point, allocators take a look at performance, and you can't deny long-term track records, right? So the era that we were in prior, where Bitcoin crashed 80, 90, 100%, that's not entirely past us in terms of the public zeitgeist. In terms of trading behavior, we'll have to wait and see. But to me, it seems we're moving into an era where Bitcoin's drawdowns are far more muted, not only because it's a larger asset, but because of the people who are holding it now and the people who are buying it from folks who are selling. And it'll take a while for the market to digest that new information and recognize that. So I do think it's going to be a multi-year, multi-decade process. And the first movers today are going to have some of the most successful funds, some of the most successful companies in the world over the next 10, 20 years. So that's kind of how I view this all unfolding. It won't be all at once. The classic Bitcoin phrase, gradually then suddenly, and it'll begin with a couple of first movers who are willing to take the plunge and try this thing out.
Yeah, it's really exciting. I feel like, I've been around prancing around in crypto since 2013, 2014. And I feel like this is the first time we're like, all right, we're branching out into the real world. We're seeing the crossover. The threads are starting to weave, into the real estate, into the bond market with like the strategy preferred options. And it's just, and gold, like, kind of demonetizing gold. So it's exciting to see. And I just watched this video earlier today. It's a guy I've never seen before. His name's Chris Drzizga. Don't know how to pronounce it. You might have seen him around real estate, Bitcoin, but he made a good little video that's basically saying more and more things are competing for capital today, than ever. You got money market funds are competing for capital, right? They're at, I don't even know, they're still at 4%, 4.5%, something like that. So, people are smartening up, information is exchanging fast, and there's getting to be less and less reasons for people to not judge real estate as being like the best bang for your buck. You're getting pulled from all different avenues, and is so leading into a question is this the most exciting kind of thing for you looking forward? Is like Bitcoin demonetizing or eating away at the margin of real estate? Or do you see other things in the whole web of assets? Like, is Bitcoin attacking those as well? Or do you think real estate is where the biggest opportunity for that is here in the next decade or so?
Yeah, I think real estate is one of the biggest opportunities in the next decade. When I think of a monetary premium, I think that, its concentration lies in assets that aren't intended to be monetary. So a home as an asset, of course, these things are financed by banks. These things are not just for their construction, but for folks who are buying them. And so a component of homes has always been and will continue to be a monetary asset, right? Banks make money off of constructing these things and financing them. But for me, I don't think that the amount of capital currently trapped in homes accurately reflects its value. I think it's tremendously overinflated. And so when I think of other assets that might have a premium over what they're actually worth, you think of individual stocks and what their PE ratios are. Ultimately, I do think because of that reason, real estate is kind of the biggest market that will siphon that monetary capital will flee from and move into Bitcoin. I think that is the largest area of concentration where money is that it shouldn't be. And so I think that particularly with, one way to put this is kind of the digital transformation of physical capital, right? The best performing stocks today are graphics card stocks, NVIDIA, database stocks, Oracle, and others, right? These equities that are tied to this digital transformation of physical capital, where more of the world is moving online than ever before, where more of our utilities and our day-to-day life is moving online than ever before. And so, I think that because of that, stocks are relatively fairly valued. When you consider all things considered, right? Price to earnings is one thing, but where the world is heading is another. And so I'd wager the stock market isn't nearly as overheated as many people expect, and that money belongs there, right? Because these people are putting their money there to make calculated bets and fund these companies in the process. Whereas with real estate, it's an entirely different game. So because of that reason, I believe that real estate, not only given its size, but given its concentration of monetary capital that just shouldn't be there, that will be the market that most money flows out of and moves into an asset like Bitcoin. It will move into other things too. But I also think that if you take a look at what's happening in commercial real estate, vacancies are basically at an all-time high for U.S. metro areas. Commercial mortgage-backed security delinquencies continue to be elevated, and they're rising. You see stories anecdotally. That was the hard data. You see stories basically every week about some new commercial real estate office tower in some major metropolitan area in the United States that's selling for pennies on the dollar. Yeah. And so, ultimately that's the direction we're headed, right? With this AI boom, with this tech boom, with Bitcoin being where it is currently, and with this demonetization of the utility value of commercial real estate because of remote work and other things. I think that as far as markets go that are primed for its monetary capital to flee into Bitcoin, I think real estate is chief among them.
Yeah, maybe you should buy one of these big downtown buildings for as Horizon grows. You could get one for 3 cents on the dollar or so. Get back into the office, Joe.
Exactly. Right.
Yeah, I mean the S&P and markets like this that makes sense, like the digital transformation of capital. That's another reflexive narrative we're talking about, right? Cementing into the minds of everybody that this is where your money goes to grow. I think that's another fascinating one, but I agree. I think that is almost just starting in a sense, where I think things in that space can go much higher and much crazier than anybody could imagine. So it'll be interesting. But we'll wrap this up here. Why don't you tell me a little bit about Horizon? I actually went through the website today and I was like, this is not what I thought it was. It's definitely an interesting take. I'm still trying to figure out like where the money comes from and things like that. Yeah. So could you break down Horizon for us here?
Of course, absolutely. So Horizon it's a very unique product, and it's one that has taken off over the last 4 months since we launched it, and we couldn't be happier with the results. We have some really big news coming up in the next couple of weeks as well. So I encourage everyone who's listening to stay tuned. But essentially, Horizon allows homeowners to swap a portion of their home's net equity for Bitcoin without monthly payments or interest charges or term limits. So it's not debt on your home in the traditional way that you think about it. You generally think when you think of home financing, you think of, okay, I'm going to get a HELOC or a HE loan or a reverse mortgage or some other kind of financing line on my house. Horizon is entirely different. So you mentioned, where does the money come from? Horizon, currently we use a home equity investment structure where essentially on one side you have home equity investors. So big pools of capital that simply want to have access to residential real estate, but they don't want to buy a CMBS or anything like that. They want direct access to high quality homes and the appreciation that comes alongside them. And then on the other side, you have homeowners who want access to capital for various things. Generally, over time, home equity investments have been used for things like home renovation or buying a new car or something else. We are envisioning home equity investments as an entirely different thing, and that is to deploy into Bitcoin. Essentially, if you do the math out and you take a look at Bitcoin's historical performance and you look at what you'll be paying with Horizon over any given period of time, generally speaking, at the average home price appreciation rate of 3% and the lowest possible Bitcoin 4-year CAGR of 26%, you're essentially coming out ahead the majority of the time. I can't say all of the time because that's not accurate. Obviously, some people bought Bitcoin, at 69,000 in 2021, and they weren't above water until 2024. And so ultimately, these things, Bitcoin is a multi-year, multi-decade asset, but essentially Horizon allows folks to act on the belief that Bitcoin is going to appreciate faster than their home, and they don't have the capital to deploy. Maybe they have a mortgage payment. Maybe they have an existing loan out on it. Maybe they just aren't making enough capital in order to do this, but they want to execute on this trade. And so we allow homeowners to efficiently access their capital to deploy into Bitcoin using this home equity investment structure. And it's very novel. It's an extremely cool thing, whether you are a homeowner who has barely any mortgage left or you have some mortgage left, whether you have the capital to deploy into Bitcoin in your own right from your monthly salary or you don't. We essentially allow homeowners to unlock, per se, that trapped capital that isn't already deployed and deploy it in Bitcoin. And essentially just set it and forget it if they'd like to. Until you sell the home or until you do a title transfer or refinance, you really don't have to think about this thing at all because of the no monthly payments and no interest accrual. You can just kind of let it exist in your house until you leave. And then at the very end of it, you've got this big stack of Bitcoin. So that's essentially the idea behind it. It's been, I'll say, wildly successful, not to toot our own horns, but it's been very, very good for us over the last couple of months. And honestly, I just love to see, this entire, not, this, I won't call it a tirade, but this speech that I've gone on a couple of times in this show about, home ownership in America and how homes are overinflated and how nobody wants to sell. Really, I feel like I'm so proud to be on this team with our mission, being able to help homeowners in their financial situation access an asset that they believe in as a monetary tool more than they do their house without having to sell. So yeah, that's a kind of a high level pitch about Horizon and what we allow for and how the product mechanics work.
So if I dumb it down, I could have a certain percentage of, like, let's just say I have $2 million home. I still have to pay off $1.5 million. I have $500K in equity, and we take 1 Bitcoin worth out of that. And basically you're going to give me, was a Bitcoin at 110? Let's just say you're going to give me $110,000, which I can go buy Bitcoin with, and I don't have to pay you back. You just now have a percent, that like pro rata percentage home part of my home, right? Like you own shares in my home now equal to that amount. And my bet is that down the road, if I sell this home for $3 million, your cut will be less than what Bitcoin appreciated over that time. Is that basically what we're talking?
That's exactly right. That's basically the brass tacks of the trade here. Essentially another way to think of it is, you are swapping a portion of your equity. I can't really use analogies for a compliance standpoint, but I will say you pretty much hit the nail on the head there. You're swapping, out of one asset and into another. And you're taking the bet that the asset you're swapping into is going to do better than the asset you swapped out of. It's extremely clean and quick and simple. And it really is a wonderful trade. We talk about the speculative attack, right? Dollars are low yielding. You borrow in low interest rate debt. Bitcoin treasury companies are doing it in order to invest in a very high yielding asset like Bitcoin. Horizon essentially allows homeowners to do that at the individual level.
Yeah, it's super interesting. It makes me think of like cycles and where we're at and when I would best think it's opportune to do that, different for everybody. But one of my favorite stats for Bitcoin is that, like, if you've ever bought Bitcoin and held it 4 years, you've never lost money. And that's just like such a cool stat to talk about with people who talk about volatility and risk and all that stuff, is that you could go back throughout the entire history. And if you just agreed, if you signed a contract to hold Bitcoin for 4 years, you will be up money, which is pretty cool, Now, in the next couple months, who knows? You never know. But
anything can happen. Obviously,
great.
Yeah. I mean, all not financial advice whatsoever, but ultimately we are creating these tools for people to act on these convictions. And it really is a very cool thing.
Yeah. So, it kind of sounds like you guys have a longer term. If you're going to live in your home for 10, 15 years, I mean, you could just take that long-term time horizon, put that into Bitcoin, and almost envision yourself as having that hybrid real estate Bitcoin portfolio, right? To do better over time. So very cool, man. Right. I think it's like, I was looking into it and I was like, oh, it's just going to be another, you're paying back a high fee thing or whatever. And I was like, oh, this is completely off the wall different and very cool. So yeah, I'm not shocked that some people are like, oh, hell yeah, get me in there. Let's do it.
Oh yeah, absolutely. Just to give a quick example, and this is illustrative, of course, but I put out this example yesterday, and this isn't about Horizon in particular, but the Horizon product does allow folks to swap equity out of their house. If you take the average home, let's say it's totally paid off, about $500,000 in America, you swap 10% of its value for Bitcoin. If you assume a consistent 31% CAGR on average over 21 years on the house, or 3-year CAGR on average over 21 years in the house, and a 21% CAGR over 21 years on Bitcoin, which is currently much lower than it is right now, then essentially your stack, your home plus BTC stack, would be worth $3.1 million. And if you just stayed in your home over 21 years, average CAGR of 3%, that 500,000 would grow to 900,000. And so ultimately, it is a way for people to execute on this trade, right? And something like 10% is very prudent for most people. You think most Bitcoin maximalists like myself, you would say, yeah, no, let me, I have a paid off $1 million home. Let me go ahead and get a 70% LTV HELOC, take as much money out as I possibly can. And then there you go. And then, buy Bitcoin with it. 10% is a very prudent number. And you can see that even with 10%, this is the transformative power of Bitcoin. Of course, this is all illustrative, not financial advice whatsoever, but just taking those assumed growth rates, given what Bitcoin has done in the past and what you can project it to do in the future. That's an example of the transformative power of Bitcoin that Horizon allows homeowners to act on.
Yeah, very cool. I like seeing visual kind of compounding gap over time there. It's hard for people to, as we know, like think linearly or think exponentially here over time. And also we want it all to happen now, Joe. We want it now. So
exactly.
Really interesting. Really like what you guys are doing there. So if at all, I think are you Joe Consorti across everything at this point?
That's right. Thankfully, I managed to snag that username before anybody else did. So it's just at Joe Consorti on X, YouTube, everywhere. But I will say, watch out for scammers. There are a lot of folks who pretend to be you. This happens to a lot of people. So I will never DM anybody. But yeah, you can find me at Joe Consorti at X and YouTube at the very least.
And he's also got a TikTok account where he's doing dances in the middle of the day to shake things up a little bit, right?
Thankfully, I haven't had to sink to that level just yet. But
we'll see, though. You never know. Yeah, okay, guys. Cheers and have a great rest of the week. Enjoy worrying about CPI tomorrow, as everybody will.